Okay, let's get into it. Today we're unpacking Netskope Inc., ticker NTSK.
Right.
And this is a big one. It's their third quarter fiscal 2026 results, which is, their very first public earnings call since that big IPO back in September.
And that's really the mission for us today, to dissect the drama here.
Yeah.
Because this call had one of the biggest disconnects we've seen all quarter.
A huge disconnect.
Yeah, the company executed, perfectly on every single metric you could look at, and yet the stock just immediately fell off a cliff.
Yeah.
So we have to figure out why. Why was the market so ready to punish what looks like success?
Let's start with the hard numbers then, because, wow, they were stellar. Netskope reported revenue of $184.17 million.
Mm-hmm.
That's not just a beat. It's, over $8 million above what Wall Street was expecting, and it's solid 33% year-over-year growth.
And you see that strength all the way down the P&L.
Yeah.
The non-GAAP earnings per share, which is what the street really watches,
Right.
came in at a loss of just 10 cents. The expectation were a loss of 25 cents.
So a huge beat.
A huge beat. Even the GAAP EPS, which has all that extra stock comp and IPO noise in it, even that beat expectations.
But for a company like this, a high-growth security name, the real story is...
Well, it's about forward visibility, right? The subscription metric.
Oh, absolutely. Those are arguably more important. And their annual recurring revenue, the ARR, it actually accelerated to 34% year over year. Hit $754 million.
Accelerated. Okay.
And the contractual momentum is, frankly, even more impressive. Their remaining performance obligations, RPO.
The RPO, right. That's the key one.
That's the total revenue they're contractually on the hook to deliver. It just crossed $1 billion.
Wow.
And it grew a staggering 41% year over year. That kind of RPO acceleration, usually that sends a stock to the moon. It de-risks everything.
Exactly. RPO growing faster than ARR is the dream scenario.
Yeah.
And yet, here's the reality check. The market reaction. The stock cratered almost 12% in the session right after the call.
12%. That's a massive, massive red flag from investors. It tells you the execution wasn't enough. The market was, priced for absolute perfection and didn't get it.
And that's where we have to start digging. You've got this phenomenal top line, incredible contractual base, but the market smells trouble somewhere.
Right.
So to understand that, we need to go deeper into the operational side. Why are these numbers so strong? And maybe what's the hidden cost of keeping this engine running so hot?
Okay, let's look at unit economics. Management was really hammering this point on the call, that their whole architecture is built for efficient scaling.
And you can see it in the margins. It's right there in the numbers. Non-gas gross margin expanded by a full 500 basis points.
500?
Yeah, year over year, it hit 75%. For a cybersecurity infrastructure company to hit a 75% gross margin, that's a big deal. It proves their whole thesis about the NewEdge network.
Their private cloud.
Exactly. It lets them deliver these complex security services without the crazy variable costs you see in older models.
And their overall efficiency is getting better, too. Operating margin improved 11 percentage points. Still negative at negative 15%, but a huge improvement.
But even more critical, they flipped to positive free cash flow.
Oh.
They generated $10.6 million. That's a 6% FCF margin.
That's a major milestone. It shows leverage. They're not just burning cash to grow anymore.
Right. They're generating it while still growing ARR at 34%. And let's not forget, they've got a war chest. They ended the quarter with $1.2 billion in cash.
Thanks to that IPO.
Yeah, over $900 million net from the IPO. Cash is king, and Netskope is sitting on a mountain of it.
So with that cash, with those margins, the business model itself seems incredibly solid. But a subscription business is all about customer loyalty. What about stickiness?
Well, they reported a very healthy net retention rate, NRR, holding strong at 118%.
118%. Okay.
Which means existing customers are spending 18% more year over year. That's solid. But what's really interesting is how they're doing it.
Multi-product adoption.
Exactly. They are crushing the platform consolidation play. They said 53% of their customers are using 4 or more products, and 26% are already on 6 or more.
So once they land a customer, the expansion just kind of happens naturally because the platform makes it so easy. And these are big customers, right?
Oh, yeah. They are laser focused on the enterprise.
Yeah.
Over 85% of their ARR comes from customers paying over $100,000 a year.
That's a high value base.
A very high value base.
Yeah.
And the average spend for that group grew 10% year over year to over $450,000 per customer.
Yeah.
So this isn't just growth, it's high quality growth.
Okay, let's pivot a bit. From the financials to the story. The strategic narrative management was pushing.
Right.
The CEO was very, very clear. This market is being totally redefined by two things.
Right.
Cloud modernization and AI.
Absolutely. They're positioning themselves at the very heart of what's called SASE, or Security Service Edge. They see the total market for this hitting like $149 billion by 2028.
Which is huge.
It's massive. And the reason is Gen AI. The CEO's point was that AI creates more data, more ways for it to be misused, and much more sophisticated risks of data loss.
So where are customers spending money right now? They called out a few specific areas.
Yeah, three main drivers.
Yeah.
Secure Web Gateway, SWG, which is basically securing your connection to the public internet. Zero Trust Network Access, ZTNA.
Never trust, always verify.
Exactly, which is critical for remote work. And then all their data protection tools like DLP and DSPM.
And the thread connecting all of this, the new hot use case, is securing those AI interactions themselves.
Right. They want customers to be able to say yes to AI, but safely. It's not just about blocking it. It's about putting up guardrails.
And this all runs on their proprietary network, the NewEdge network. That's their big infrastructure play.
That's their moat. It's what allows them to break what they call the security paradox. You know, the old idea that more security always meant a slower network.
Right.
By running everything on their own 120 plus data centers around the world, they just added new ones in Hawaii, Malaysia, Toronto, Oman. They kill the latency problem.
And speaking of AI, they really insisted it's not just an add-on feature, it's foundational.
Yeah, they have two dedicated teams. Netskope Threat Labs, which has found over 1,400 zero-day threats, and then Netskope AI Labs, which has built over 170 of their own proprietary machine learning models.
They used that AI house analogy on the call, which I thought was pretty effective.
Yeah, it was. The basement is the underlying AI platform itself. The back door is how AI agents talk to each other. And the front door is the user interaction, where you need to control the prompts and responses to stop IP from leaking out.
And it seems to be working. They said they already have over 1,000 customers using their tools to protect Gen AI interactions.
And partnerships are a huge part of this too. They highlighted deeper Microsoft integrations, full integration with Purview, and new protections for Microsoft's 365 Copilot.
And the CrowdStrike one.
Right, with CrowdStrike Vulcan for sharing threat intel back and forth. They're building a real ecosystem.
And we saw some real proof in the customer wins they shared. Tell us about the scale of those deals.
Two massive ones. First, a Fortune 50 global pharma retailer picked Netskope for a complete zero-trust build-out for 50,000 employees. That's a huge platform win.
But the second one, the federal one, that was the showstopper.
Oh, yeah. A major expansion with a large U.S. federal civilian agency. They went from 7,000 users to 300,000 users.
300,000.
And from just a couple of products to 8 products. It's a massive leap. It shows they can meet those incredibly strict federal cybersecurity mandates that a lot of competitors just can't.
So, okay. The underlying business is a monster. It's firing on all cylinders. Now we have to get to the elephant in the room, the guidance.
The guidance. This is the heart of the whole disconnect.
Despite that huge Q3 beat, their forward look was, well, it was modest.
That's the kindest way to put it. They guided full year FY26 revenue to like $701 to $703 million, and free cash flow to just $5 to $8 million. Management tried to frame it as being cautious, early in their public journey, macro uncertainty.
But investors heard disappointment. That's what they heard. The stock was priced for perfection, and this guidance was not perfect. So what operational reasons did they give for the margin pressure?
They were pretty transparent, actually. The CFO explained they were in a critical investment cycle. Two areas. First, R&D to stay ahead in AI. Second, and this is the big one, they are hiring sales reps aggressively.
And the investment cycle for a sales rep is key, isn't it? You pay them now, but the return takes a while.
Exactly. The ramp time for a new enterprise sales rep is typically 9 to 12 months. So Netskope is eating that cost right now, which pushes down their immediate operating margin.
But they won't see the ARR from those reps until, what, late fiscal 2027?
Right. It's a classic long-term growth move, but it makes the near-term P&L look a little rough, which is exactly what the street hates.
And on top of that, they mentioned a change in billing terms. Explain that, because it mets with the cash flow numbers.
Yeah, this is a huge factor. They're moving multi-year contracts to be billed annually instead of demanding a huge payment up front.
Which is better for the customer.
Much better.
Yeah.
It's customer-friendly, reduces friction. But in the short term, it makes your calculated billings and your cash conversion look lumpy and weak. So analysts focused on cash flow saw that dip and panicked, even though the actual contractual commitment, the RPO, is still rock solid.
So let me sum this up. Incredible execution gets totally overshadowed by temporary costs from hiring and a technical accounting shift. The market basically looked at the next 3 months and ignored the 41% RPO growth.
It absolutely smells like an overcorrection, a total short-term freakout, especially when you hear that options traders were betting 7-1 on the stock going up.
Oh.
So when that pop didn't happen, it forced a brutal immediate reset.
Okay, this is where we switch gears for our This Is Not Financial Advices segment. Because this set up a fantastic company getting hammered on a double-digit sell-off with $1.2 billion in cash. This feels like an opportunity.
Our outrageous but plausible trade idea is this. You take a long position on Netskope right here. Target a move back toward the street's average price target of around $26.
But what's the catalyst? The core business is great, but management needs to change the story, and fast. How do they do that?
They have to use that giant pile of cash to signal maximum confidence and just ram home that AI security story the CEO was telling. Management should immediately use $100 to maybe $200 million for a small strategic tuck-in acquisition in the generative AI security space.
Ooh, okay. That does two things at once. It buys them technology, shortening their own time to market on AI features.
Exactly. And more importantly, it creates an immediate catalyst for the stock. It proves they are prioritizing aggressive market capture in AI over just pinching pennies on margins for the next 2 quarters. It forces investors to look up from the spreadsheets and back at the massive growth story.
So, to recap our whole deep dive here, Netskope delivered phenomenal growth, 34% ARR acceleration, RPO over $1 billion, great margins, positive cash flow, but it was all derailed by investor anxiety over conservative guidance and really some temporary headwinds from investing in growth.
Which brings us to the final thought you need to chew on. Netskope has this massive structural advantage with its platform and its NewEdge network, perfectly built for the AI security boom. So the question is, does today's stock price just reflect a temporary market obsession with short-term profits? Or has the whole high-growth cybersecurity cycle finally peaked?
That is the fundamental question for this entire market right now, and one you need to think about carefully. As always, this analysis is just for informational purposes. It is absolutely not financial advice. We just hope this deep dive helps you make sense of the noise.